Hey everyone, welcome back to Corporate Decoder, the place where we make sense of the money world. Tonight we're diving into Electronic Arts' latest earnings report, and let me tell you, it is a wild ride of numbers that tell a story about where this gaming giant is headed. So EA just dropped its quarterly report, and as usual, they're showing us a snapshot of their financial health. Imagine getting a report card for how well a company is doing. That is basically what this is. We're going to break down the key numbers and see what they really mean for the company and for us, the players and investors. And before we dive deep, if you appreciate getting straight insights from these corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below where we break down more financial news if you want to join the conversation. Let's start with a look at their balance sheet, which is like a snapshot of what EA owns and what it owes at a specific moment in time. As of the 31st of December 2025, they had total assets valued at a massive $13.28 billion. That is a lot of digital worlds and creative talent. Now, what is interesting is how those assets are structured. They have $4.108 billion in current assets, which means things they can easily turn into cash within a year. This includes their cash and cash equivalents, which jumped from $2.136 billion to $2.784 billion. That is a healthy increase in readily available money. Then there is goodwill, sitting at $5.388 billion. This is what happens when a company buys another company for more than its identifiable assets are worth. It is like paying a premium for brand name or future potential. It is a significant chunk of their assets showing they've been active in acquiring other businesses. On the flip side, their liabilities, what they owe, totaled $7.128 billion. This includes things like debt and money owed to suppliers. Now for the income statement, or as they call it here, the statement of operations. This shows how much money they made and spent over a period. For the 3 months ending the 31st of December 2025, their net revenue was $1.901 billion. That is a slight increase from the $1.883 billion in the same period last year. So, revenue is holding steady, but look at the operating expenses. They shot up significantly. Total operating expenses were $1.276 billion compared to just $1.050 billion the previous year. That is a jump of over 20%. Because expenses went up so much, operating income took a hit, dropping from $377 million to just $127 million. That is a 66% decrease, and net income followed suit, falling from $293 million to a much lower $88 million. On a per share basis, that means diluted earnings per share went from $1.11 down to $0.35. That is a big drop, and it shows that while they're bringing in similar revenue, it is costing them a lot more to do so. Interestingly, the number of shares used in the basic earnings per share calculation went down from 262 million in the prior year to 250 million. This suggests they might have been buying back some of their own stock, which can make earnings per share look better. Moving on to comprehensive income, which is basically net income plus other income and losses that are not part of day-to-day operations. Here we see that their total comprehensive income was $117 million for the quarter, down from $345 million the year before. The biggest swing here comes from gains and losses on derivative instruments, which can be complex financial tools. For the quarter, they had gains of $27 million on derivative instruments compared to $90 million the previous year. This is a key area to watch as these can be volatile. The statement of stockholders' equity shows the changes in the investment of the owners over time. Their retained earnings, which is the accumulated profit the company has kept over time, decreased from $6.470 billion to $6.194 billion. This is likely due to the lower net income this quarter. Also, note the significant repurchase of common stock, which appears to be a substantial amount of money being used to buy back shares. For the 9 months ending the 31st of December 2025, they spent $769 million on common stock repurchases. That is a huge amount of money being returned to shareholders by buying back stock, which can boost the stock price but also means less cash for other things. Now let's talk cash flow. This is essentially the lifeblood of any company. For the 9 months ending the 31st of December 2025, net cash provided by operating activities was $1.973 billion. That's up from $1.530 billion the previous year. So even though their reported income was down, they generated more actual cash from their core business. That is a good sign. A big driver of this cash flow increase comes from deferred net revenue. This is money received for services not yet performed, like subscriptions or future game content. It went up by a massive $789 million. This means people are paying for future content, which builds up this deferred revenue and provides cash now. However, their investing activities show they used $214 million, and their financing activities used a whopping $1.133 billion, largely due to those stock repurchases we just saw. While generating cash from operations is good, a significant portion of that cash is being returned to shareholders or used for acquisitions. Now, let's dig into the notes where the really important details hide. First, the big news is that EA has agreed to be acquired by a consortium of investors. This deal, expected to close in early 2027, means EA's stock will likely be taken off the public market. The purchase price is $210 per S-share in cash. This is a massive change for the company and its shareholders. They've also made a change to how they recognize revenue for online services, extending the estimated offering period. This means they will spread out revenue recognition over a longer time, for the quarter ending the 31st of December 2025. This change resulted in an estimated decrease in net revenue of $25 million and a hit to earnings per S-share of 8 cents. This is a cosmetic accounting change. Really, it does not change the total value over time, but it does affect how reported revenue looks quarter to quarter. The company also details its fair value measurements, which is how they value certain assets and liabilities like investments. Most of their financial instruments are classified as Level 1 or Level 2, meaning their value is based on observable market prices, which is generally considered less risky than Level 3 assets that rely on unobservable inputs. They use derivative financial instruments, mostly foreign currency forward contracts, to manage risks from operating in different countries. They have both cash flow hedges and balance sheet hedges. These are complex instruments, but essentially they are trying to protect themselves from currency swings. The report shows they have substantial notional amounts tied up in these contracts. Accumulated other comprehensive income or loss shows unrealized gains or losses on certain investments and currency translations. As of the 31st of December 2025, they have an accumulated loss of $127 million, largely driven by foreign currency translation adjustments. Their goodwill is massive, as we saw on the balance sheet. They also have $219 million in acquisition-related intangibles. These are things like acquired game franchises or technologies. They amortize these over time, and the report shows a clear schedule of future amortization expenses. Looking ahead, EA has significant future commitments for developer and licensor payments, totaling over $2.1 billion that are not yet recognized on their financial statements. They also have substantial marketing commitments and obligations under senior notes and operating leases. This shows they have significant future obligations to manage. They spend a considerable amount on stock-based compensation, over $500 million for the 9 months ended the 31st of December 2025. This is how they pay and retain their employees, but it also dilutes the value of existing shares. The company has been actively repurchasing shares, but has suspended these activities in contemplation of the merger. They bought back millions of shares for hundreds of millions of dollars in the past year. The diluted earnings per S-share for the quarter was $0.35, a sharp drop from $1.11 the year before. This confirms the impact of rising costs and lower net income. Looking at the revenue breakdown, full game downloads are showing growth, while packaged goods sales are declining, which is a clear trend in the industry. Live services and other revenue remained relatively flat. As we saw with operating income, cost of revenue increased. For the quarter, it was $498 million, up from $456 million last year. And as a percentage of net revenue, it went from 24% to 26%. This means it is costing them more to deliver their products and services. Research and development expenses also rose significantly, up 16% for the quarter to $704 million. EA is clearly investing heavily in creating new games and technologies. Marketing and sales expenses jumped by 42% to $356 million, driven by new game launches like Battlefield 6. This is a big spend, but necessary to get their games in front of players. General and administrative expenses also increased, partly due to merger-related fees. This shows the cost of managing a large global company and dealing with significant events like this acquisition. Their effective tax rate increased to 33% from 28%, mainly due to global minimum tax impacts. This means they're paying a higher percentage of their income in taxes. Despite the lower net income, cash from operations is strong, up 55% year over year. This highlights the difference between accounting profit and actual cash generation. The company has a significant amount of senior notes outstanding, with almost $2 billion in principal. The fair value of these notes has fluctuated, and they recently redeemed their 2026 notes. They have a $500 million revolving credit facility, but thankfully they had no outstanding debt on it as of the 31st of December 2025. This provides a safety net if they need cash. Looking at their future obligations, they have over $6.7 billion in total unrecognized commitments, including developer and licensor agreements and operating leases. This is a substantial amount of future spending they need to plan for. While not detailed here, they mention that they are subject to claims and litigation, but do not believe any individually or collectively would have a material adverse effect. Now, for the risks, the biggest one is the proposed merger not closing or being delayed. This uncertainty could hurt their stock price and business operations. They are also facing lawsuits related to the merger. Competition is fierce as expected in the gaming world. They acknowledge that their success depends heavily on delivering popular games, and that a few key franchises like EA Sports FC and Apex Legends drive a significant portion of their revenue. The underperformance of any of these could have a huge impact. Development delays are a constant threat, and if they miss key selling periods, it could significantly impact their results. The tech industry is always evolving, and EA acknowledges the need to adapt to new technologies, business models, and distribution methods. They are also looking at how artificial intelligence will change things. They also face high expectations from stakeholders regarding quality and integrity. Player feedback and concerns about game content and practices can negatively impact their reputation and sales. They're also dealing with issues related to user-generated content and the potential for bugs or defects in their complex software. Cybersecurity is a major concern, and they mention facing ongoing threats like ransomware and data breaches. The rise of AI could also lead to more sophisticated attacks. EA is heavily reliant on powerful partners like Sony, Microsoft, Apple, and Google for distribution. Changes in their policies or platforms could significantly impact EA's business. Global regulations around data privacy, consumer protection, and even digital services taxes are a growing concern, potentially increasing compliance costs and limiting their operational flexibility. Finally, like any global company, they are exposed to currency exchange rate and interest rate fluctuations, which can impact their revenue and investment returns. So, what is the takeaway from all this? EA is in a period of major transition with that proposed acquisition, financially. Revenue is stable, but profitability is under pressure due to increased spending on development, marketing, and also the costs associated with that pending acquisition. Their cash flow from operations is strong, which is a positive, especially with the heavy investment in new games and technologies. However, the reliance on a few key franchises and the intense competition remain significant risks. The merger itself introduces a whole new layer of uncertainty and potential disruption. Looking at it like Warren Buffett would, EA has strong brands and a dedicated player base. But they need to carefully manage their costs and adapt to a rapidly changing industry landscape, especially with that acquisition on the horizon. The success of this deal and how they navigate future product launches will be critical. Alright, that is our breakdown of Electronic Arts' latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.